Hi, I'm Pete Comley and author of Monkey with a Pin, and also a private investor just like you. In this short video, I'm going to tell you what my book is about and why you should read it. Also, I'm going to show you how you can get it for free. Yeah, for free! Have you ever wondered why your returns when investing are never quite as good as you expect them to be? Do you want to know ways to get more out of your investing? Then read my new book called Monkey with a Pin. It describes how investors rarely make the long-term 5% above inflation yield promoted by the finance industry. That is because it turns out just to be a theoretical number from which you need to deduct a number of things which seriously impact on your profits. Therefore, in reality, you may be lucky to even match inflation by investing in shares or most funds. Indeed, over the last 20 years, the average investor would have been probably better off just keeping their money in a cash ISA in the building society. I was inspired to write it after listening to a podcast by David Quo of Motley Fool. In it, he said that 85% of fund managers couldn't beat the index. And I thought when I listened to that, that can't be right. They're paid so much money. But I looked it up and it's true, they can't. So it set me on a sort of trail of investigation to find out, well, what were the average returns for a private investor like you and me? And I soon realised that the actual returns were quite different to the theoretical 5% return. From it, you need to deduct three things. One, your skill or lack of it. Secondly, something called survivorship bias. And then thirdly, your costs. So let's have a look at each of those in turn. To determine the skill element, I initially looked at investors' competitions, such as the UK Stock Challenge. It had been running annual competitions since 2004, and when looking back through their historical records, I noticed that the average participant often doesn't beat the FTSE. Moreover, their Monkey with a Pin entry, which picks stocks at random, consistently beat 2/3 of participants. Last year, the monkey was in the top 10% of contestants. Astonishing, isn't it? I then started to look at the academic literature, and I found a very interesting study which looked at every single one of the billion or so trades on the Taiwanese stock market over a period of 5 years in the late 90s. And from it, it was able to conclusively prove that the private investor loses about 1.3% a year due to their bad trades. However, other literature shows that the figure is worse for those who invest in funds. Because they tend to buy and sell at the wrong time, their average losses are around 2.2% a year. My book also highlights another reason why investors never quite get the returns of an index like the FTSE. This is because the FTSE is an index of successful companies. All the poor ones are removed from it. This is an effect called survivorship bias. Therefore, for all investors who don't use index trackers, this effectively loses them another 1.1% a year. But the biggest cause of underperformance is that of charges. These affect investors in funds slightly differently to those who pick shares directly themselves. For fund users, it's not just the average TER of 1.7% that needs to be deducted. There's also an average further 0.6% of hidden charges because of portfolio trading that are not even disclosed to investors. In addition, there are the effects of initial charges, which can be one-off fees of up to 5%. In writing this book, I spoke to many private investors. They told me one of the key reasons that they were selecting their own portfolio and not using funds was to avoid the charges. However, what they fail to realise is that the total costs of trading yourself are sometimes far greater. The key element here is commissions. Even if you pay just £12.50 a trade, this is still £25 to both buy and sell. And if you tend to trade around £1,000, as many people do, this adds a further 2.5% to your costs. In addition, you need to factor in stamp duty, 0.5%, and also the bid-offer spread, which for many small companies can be 1% or more. The book shows that the total of all of these effects reduced the average private investor's returns by 6%, meaning that across all investors over a long time period, their returns are slightly negative, having taken into account inflation. Further, they are far from those projected by the industry to encourage people to trade in the first place. Now, don't get me wrong, I don't want to put you off investing. I'm still a committed investor myself. The second part of the book, I go on to talk about the implications for private investors on how you can best beat the system and still get a positive return. I critically review a number of trading systems like buy and hold, dividend investing, and conclude that basically none of them are a foolproof method. Instead, if there is a magic bullet at all, it's probably that you just have to create your own simple set of rules, write those rules down, and then follow them. Indeed, in my own investing now, having written the book, a key element is going to be using index trackers. I also intend to follow what I call the monkey strategy of picking some shares purely at random for part of my portfolio. I also highlight the importance of not following the herd and only buying when the index or specific stocks are genuinely cheap. This may mean waiting in cash for the next downturn, which I think could be in the next year or two. I also reveal a number of recommendations on how to cut your trading costs. The key one, though, is to just cut down how much you trade. If you do one thing after reading my book, please go out and have a look at your portfolio turnover rate last year. If it was greater than 100%, I think you need to reduce it. Finally, the best thing about this book is that you can read it for free. I wrote it for other private investors like you. There is no catch. I'm not trying to sell you anything. I genuinely want you and your investing to be more profitable as a result of the information that I've found out. It is listed on Amazon Kindle and is about to be in the Apple iStore. You can also read and download it in other formats for free from the book website at monkeywithapin.com. Good luck with your investing and bye from the monkey and his pin. Bye!